A very good afternoon, good morning. Welcome to the FX Week Ahead live market analysis with myself, Giles Coughlin, Chief Currency Analyst. Very warm welcome to you, especially pleased to be seeing everyone ready for this week. More exciting week this week. We have a number of central bank meetings, Reserve Bank of New Zealand and the Bank of Canada. So as a consequence, we could potentially see some volatility in the Canadian dollar and the New Zealand dollar this week. So there's plenty to cover. Very warm welcome to you as you're coming in. Just as folks are coming into the webinar, don't forget that as we talk about different entries, exits, we are doing this from an educational perspective. The idea is you look over my shoulder, you see how I make professional trading decisions, someone with a professional trading background, and over time you can understand those concepts and implement them into your own trading. For the sake of clarity, this is not a signal trading service, so it's not like we say buy this, buy that, because obviously we don't update trades, when to exit them, when to change them. Instead, you're looking over my shoulder so you understand how I go about making trading decisions. The whole point of this workshop, webinar rather, is to get ready for the week ahead. So these are the major issues that we'll be looking for. We're looking at gold, very key drivers going on in gold. I'll just run through that with you. Looking at the Bank of Canada policy decision, RBNZ policy decision, looking at Australia labour data. We'll be checking out the pound, as well as FOMC minutes and what we can learn from the US consumer and US retail sales this week. So there's plenty to be getting on with this week. Don't forget those, if you've just joined the workshop, the webinar, please, you can use the question panel and the Q&A or the chat box to ask any questions. Remember, the only silly question is the question that you don't ask. It's an open invitation. Anything that you're not clear of or would like some more clarity, please do not suffer in silence. Just put your question down and I will get to it at the end of the webinar or as I go along, depending on it. So if you haven't familiarized yourself with the question box, look at the GoToWebinar control panel and you'll see it there. Great, without further ado, we'll go into the main screens and we'll just quickly run over the risk tone. Now, what's going on in the markets at the moment is a little bit of uncertainty after last week. So we're seeing mixed risk tones, and some of the key narratives at the moment are COVID-19 and the Delta variant. We're seeing a divergence now between those countries that are vaccinated and are opening up against those countries which are very slightly vaccinated, like Australia and New Zealand, and countries, emerging markets, which haven't had any vaccinations at all. So there's going to be a divergence between those countries which are vaccinated and opening up their economies and those that aren't. So the Australian dollar, you can see here, is a little bit weaker this morning, and that's weaker not only on dollar strength, but it's also weaker on the fact that the Delta variant is spreading through Australia. Now, only 9% of Australia's population has a double vaccine. So Australia is very vulnerable to the spreading Delta variant. So look out for that pressurizing the Australian dollar throughout the session. Looking at risk tones, the risk tone is mixed. Dollar is slightly firmer. Looking at commodities, we see commodities are generally weaker. Copper lower. Iron ore still well supported, but WTI crude and Brent crude both lower as OPEC have announced that they can't see any ways of making progress on the OPEC talks at the moment. Remember with OPEC, what's going on? There's a disagreement between the UAE and Saudi Arabia. UAE want to up their production levels. Saudi Arabia don't want them to, because if they allow UAE to up production levels, then Russia and all the other countries are going to ask to up their production levels as well. So there's a political battle going on with OPEC. That hasn't found any leeway at the moment. Broadly speaking, remember the crude prices. The broad perspective is that the second half of this year is going to see lots of demand for oil, and the supply level is quite low. Politically, it's quite difficult to talk now about further oil exploration. Even oil companies themselves are not wanting to look at further oil exploration. So there's likely to be a fall in oil supply throughout this second half of the year. Now, what that means, and this is what I'm personally looking at, is I am bullish on oil, but I don't want to be buying at these high prices. You see how extended oil is. Instead, I want to look at the first opportunity, which I consider good value for buying, which is at that 68.67 region. So if oil falls down to this zone, I'm expecting to buy. What might make oil fall down? Well, if we had a US-Iran nuclear deal agreed, that would mean 3 million barrels per day extra supply in the market, and oil will probably sell off quite quickly. So I'm looking for this region to buy oil because the medium-term fundamentals are good. Look how oil's just been on an uptrend, and that's for exactly the same reasons which I outlined. Now, today, oil is slightly weaker with the mixed risk tones in the market. Now, taking a look at bond yields. Now, bond yields are slightly lower as well. So remember, bond yields, when yields fall, that is negative for risk sentiment. So falling bond yields is one negative risk factor. We also have volatility just pulling off some of its recent morning highs. So looking at the global indices, they're generally well supported, and volatility staying below that 1780 region. And as long as it stays below there, we expect equity markets to keep moving higher. However, looking at currencies, we're seeing broad risk-off moves. Australian dollar, broadly lower. CAD, lower on the lower oil. New Zealand dollar, lower as well. And we're seeing strength in the safe havens, the yen, the Swiss franc, and the US dollar. So we're seeing a risk-off flows into the currency space. So quite a mixed picture at the moment as we start the week. So this day and this week, look to the risk tone to find out which currencies you want to be trading. Now, one aspect we want to look at is what's the outlook for the pound. Now, the outlook for the pound is strong over the medium term. 50% of the UK's population has now been vaccinated. The UK economy should be opening up fully on the 19th of July, so just 1 week away. And the UK has about 190 billion pounds sterling of savings that are ready to be released into the economy. So a pair that I'm really interested in is the pound Australian dollar. Now, if you look at this pair, I am long the pound US dollar from last week, and actually the week before. And if you look, do you see this key overhead resistance which broke up to the upside last week? Now, there's a divergence between the UK and Australia. Australia are looking at going back into lockdowns. The UK is looking at coming out of lockdowns permanently. So one nation is about to flourish economically. The other nation is about to have a retrograde step. So there's a divergence between the two. And one interesting little tool you can use is you can use a bond yield spread. And if you just look at the bond yield spread here between UK bonds and Australia bonds, I'll just get this so it looks more attractive and get rid of that other one. If you look at this now, you can see, do you see how the price tracks that bond yield spread? This is just a difference in the spread between the 10-year bond in the UK and the 10-year bond in Australia. Price tracks the spread very carefully. You see the spread moving up to those recent highs, just pushing above these highs here, all the way from 2021 in February and June 2021. So reaching highs in the bond yield spread. This indicates more upside in the currency pair, and as a result, any moves into this region here can be considered suitable for buyers. So any move down to that 1.1850, I'd expect upside. Stops can be placed very tightly just below that 1.1800 region, and I'm looking at a first target up into that 1.8800 region, and then possibly even more up to 1.952. So there's a lot of upside potentially that's developing here for the pound Australian dollar pair. It's my trade of the week. It's one I've been long in from, last week, the week before. So also technically a little learning point, you have a Harami inside bar. So you've got a Harami inside bar is when one bar is inside the body of the other bar. So if you look at this, let's see, let me show you. Right, you see this bar here? This bar is an inside bar, but it's not a Harami inside bar. A harami inside bar is when the body of the baby candle is inside the body of the mother candle. So you can see there, the body of the baby candle is outside the body of the mother candle. Here, you have an inside bar with the body of the baby candle, if you like, is inside the body of the mother. So it's a harami inside bar. You now have a harami inside bar break to the upside. It's a technically strong buy signal. And now we have a break above that overhead resistance. It's a break and close above 1.1850. That's another bullish development, and we're looking to be on target to test that 1.8700. So pound Australian dollar really looks good. If you're looking at potentially trading that, use the bond yield spread to help you. So if you're in this trade and you don't know what to do, check out the bond yield spread. It will guide you. Do you see how the bond yield spread tracks the price very closely? As the bond yield spread falls, the currency falls. The way you use a bond yield spread is use it like a risk profile. So it's telling you which country is expected to do better than the other. And this sharp move higher in the bond yield spread is bond traders telling you they expect the UK to do better than Australia over the medium term. That's the message that's sending out. Technically, we really like this for upside. Any falls further, any falls back down to 1.8400, any falls down to 1.820 would look very good value. So, you know, an even better place to enter would be any further drops here. So that's one currency pair firmly on my radar. Now, as we look at the week ahead, let me just yes, Suman, can we expect tapering from the Bank of Canada? We will be covering that, Suman. We'll look at that very, very quickly. So we'll be looking at that very, very shortly. Let's now look at the calendar. Let me just quickly go here to the calendar. And I'll point out some of the most significant developments for this week. Now, we have a 10-year bond auction coming up later today. Now, it's worth having a look at that. Now, let me just show to you briefly what happens with the bond year auction. Now, the bond year auction just tells you what the demand is for the bonds auction. So this is when the Federal Reserve auction off bonds. And remember, this is when you're lending money to the US government, okay? And companies, large investment companies, pension funds, they buy bonds. Now, the bond auction is looking at how much demand there is for the bonds. So this metric on the right, this is the bid to cover ratio. So when this bid to cover ratio goes up, it means there's strong demand for bonds. When the bid to cover ratio goes down, it means there's low demand for bonds. So if the bid to cover ratio, if it goes down below 2.2, that will show us that there's low demand for bonds, that bond traders are expecting rising interest rates, okay? So if that 2.5, if the bond year auction comes in at 2.2 or below, you'd expect to see upside in the dollar, upside in 10-year yields, and downside in gold, okay? That's the bid to cover ratio coming later. Now, if we saw very high demand for bonds, if it came in at 2.8 or above, that means people want to buy bonds. That's downside for 10-year yields, downside for the 10-year, downside for the dollar, upside for gold. Okay, so that's coming up later today. We also have CPI data out tomorrow. Now, inflation data is very important for the Federal Reserve. Remember the big story that's been going on over the markets over the last sort of few weeks. Is inflation out of control in the US? If it is, the Federal Reserve will have to raise interest rates. So if that CPI data comes in very strong, say the CPI data comes in like above 0.8% month on month, and say the core region, which is the most important, so that comes in above 1% tomorrow, right? If that comes in at 1% tomorrow, then there'll be lots of upside in the dollar. So that's the situation. You see lots of upside in the dollar, and that would pull down something like the Australian US dollar very sharply. So look out for that. Also, I'll give you a clue. With the dollar yen, this currency pair tracks the US 10-year yields. So if you notice, 10-year yields going up, US dollar yen goes up. 10-year yields going down, US dollar yen goes down. You get the picture? So the recent fall in US 10-year yields has dragged the US dollar yen down. So this is what to look for on Tuesday. If that comes in very strong, then look to buy the US dollar Japanese yen. Do you see how there's a bit of support here in the US dollar Japanese yen? Look, technically we've broken down through this level, but do you know what? I really like I like this. I'm tempted to step in this myself, and if I see a good reading in the CPI, I will be buying the US dollar Japanese yen. First target to 110.60, and then second target up at that 111, 150 region. So that's something to look at. Definitely look at those US 10-year yields. Don't miss that, coming tomorrow. Then we have RBNZ rate statement. Very, very important to get what's going on here. Now, let me just run you through this. Right, the Reserve Bank of New Zealand, the last economic indicators from New Zealand have been very strong. We had GDP came in 2.4%, fantastic. The prior was minus 0.9. Look at the CPI year on year, 1.5%. High GDP, high CPI, the unemployment rate low, so that's good, good, good. Three good readings. We've had three individual investment banks saying that they expect the RBNZ to hike interest rates this year. That's right. They expect the RBNZ to hike interest rates this year. Now, if you look here, you can just see the RBNZ made a hawkish tilt around the middle of last month. Just coming into the middle of May, rather, they made this hawkish tilt and the New Zealand dollar rose higher. We then saw the 1 year and the 2 year yields in bonds spiking higher, and then they fell lower. Why? Because it's like the market didn't believe the RBNZ. But then we had the first quarter GDP beat when it came in at that wonderful 2.4%. Then look at the bond market, and that's bond investors saying we're expecting interest rate hikes from the RBNZ. So that's strength into the New Zealand dollar. Now, we then also saw very high inflation out of the RBNZ. How do you manage inflation? The way you control inflation is by raising interest rates. Do you see? So the economy is doing better than expected. Bond traders are expecting interest rate hikes. Inflation is rising. The RBNZ dropped their quantitative easing packages. So all of that means the situation is improving. But here's the decision. Here's the tricky bit. Is it really going to move the RBNZ? Are they really going to say we're going to raise interest rates in 4 months' time, in November? Now, this is one key thing to be aware of. Now, look with me at the problem that New Zealand has. Okay. Now, do you see New Zealand here? They have double vaccinated 10% of their population. Now, compare that to the UK, which has vaccinated 51% of their population. So that means when the Delta variant spreads in New Zealand, it makes some people very, very sick, and some people will die, sadly, because of the variant. New Zealand is not vaccinated sufficiently to do what the UK is doing, where the UK is saying, yes, COVID is spreading terribly. If you look in the UK, you can see we have got a huge surge in COVID-19 cases. So you might think, well, why are we opening up? Because the UK is taking the gamble that although cases are rising, hospitalizations and deaths are not rising. And you can see here, these are the hospitalizations in the UK. They're rising, but nowhere near the speed and the pace of how they were rising before in the last spike in COVID-19 cases. So everything's controlled in the UK. That's the gamble. And it's because most people are vaccinated and all of the vulnerable group are vaccinated. So the UK is saying, let's open up the economy. New Zealand can't do that. So that means when it comes to the RBNZ, when they meet this week, Are they going to be able to say we're going to hike interest rates this year, or are they going to be more conservative? Are they going to want to risk pushing the market, pushing their own economy too hard? I don't think they will. So this is what you need to look for, and this can give you direction in the New Zealand dollar. So if the RBNZ say we've no longer seen a need to maintain current stimulus for considerable time, in other words, if they say we can stop our bond purchases, that's strength for the New Zealand dollar, New Zealand 10-year yields, and you could look at pairing it with New Zealand dollar yen as long as risk on tone remains. If they explain that the May hike projection will likely be brought forward in August, then if they do that, then that means sooner interest rate hikes means New Zealand dollar strength. If they say we've had much better economic data, meaning goals will be met much sooner, so that's like business confidence is high, the inflation is high for household, the GDP is high, that will be strength for New Zealand dollar. And if they announce tapering of bond purchases, look for New Zealand dollar strength. If they say tapering bond purchases, New Zealand dollar strength, New Zealand dollar yen upside looks very, very likely. Now, if they're dovish, if they say, look, we have to keep stimulus for considerable time, we think the market is too aggressive about when we'll normalize. We're not going to be raising interest rates in November. Yes, we've had better economic data, but they say, well, that's not going to bring forward our policy normalization. We're still cautious. If they announce bond purchases will stay intact with no changes in mind, all of that is negative for the New Zealand dollar. And I'd look at going along something like either short New Zealand dollar yen or long Aussie New Zealand dollar. So look at that. So that's what you need to do. If you haven't seen this, just take a quick screenshot of that, and then you can get yourself ready for the event. Okay. So big event on Wednesday, well worth looking at. US dollar PPI, now producer price index, that tells you what prices producers are paying. Watch out for it. If that starts rising higher, that means producers are having to pay more for their goods, and if producers have to pay more for their goods, eventually consumers will. So this is a key driver for inflation. So if that suddenly spikes higher, that will raise inflation worries. Think US dollar strength, US dollar 10-year yields, US dollar Japanese yen to the upside. Now, this is going to be very interesting. Bank of Canada rate statement. Now, Canada is doing well. They really are doing well. The last jobs report out of Canada was strong. Now, I was covering this all on Friday, and I was putting up loads of stuff on my Twitter. Don't forget, have a look at my Twitter feed. And if you go to my Twitter handle, which is at Giles Coughlin CCA, I'll just put that into the chat box. If you follow me there, you will be able to follow all of my tweets. And I was covering this very carefully on Friday. Now, I'll just quickly go to the calendar. They haven't got all the details here in the calendar, but I'll talk you through the missing bits. So the employment was a great beat of 230,000, but I'll give you a tip. Whenever you're looking at employment, which is better, full-time or part-time? The answer is obviously full-time, because full-time employment means more people are working for longer hours. Now, this was strong data, but it was mainly part-time workers. However, the general consensus is that Canada is opening up and that the labour market is nearly back to pre-COVID-19 levels. So Bank of Canada is going to be optimistic about the Canadian employment data. And unlike something like New Zealand, who haven't vaccinated much of their population, if you just take a look at Canada's vaccinations, you'll see that, oh, look, much closer to somewhere like the UK, 43%. So they're going to be following in the UK's footsteps, which means that that good employment data is going to result in nearly back to pre-COVID-19 levels. So the Bank of Canada is going to have confidence to start looking at tapering. Unemployment rate 7.8%. Now, there's also one other metric which isn't included on this calendar, and that calendar is called the, that data point is called the participation rate. Now, the participation rate is how many people of the available population that could work are in work, and the participation rate went higher. So what that means is very good news, and it's excellent news for next week's statement. Now, let me just run through to this current week. Okay, so where are we? There we go. So that's the Bank of Canada rate statement. Now we've got employment data on Australia. Now the Australian employment metric is going to be very important. The RBA really do focus on the Australian dollar, so we're gonna really be looking at that in a lot of detail. Again, you need to find a data point that comes in, and it needs to be full-time employment. So look at the headline. If the headline is like above 115,000, 120,000, that would be very good for the Australian dollar potentially. But you got to remember the problem with Australia is that you might see any strength faded because Australia have only vaccinated 9% of their population. So look out for kind of any strength that comes out of the employment data to then be faded. If the unemployment rate goes below 5%, that's very bullish. So look out for that on, look out for that on Thursday. It's very, very important for the Australian dollar. Then we've got CPI data for New Zealand dollar. That will be important. Higher inflation means more likely interest rate hikes. So remember, have to understand that in light of what's happened with the RBNZ. And then we have retail sales data in the US. Now remember, for the US dollar, we'll have a quick look at the US dollar. Really what we're looking at here is if interest rates are expected to rise, expect the dollar to rise. If interest rates are expected to fall, expect the US dollar to fall. So that's the big picture that's going on, the battle that's going on with the US dollar. Now, let's just see what to show you. Yeah, just with the retail sales, look at the US. The US is a consumer-driven economy, so 70% of the US's GDP comes from its consumer. So if the US consumer is doing well, then that's a positive signal for the US dollar. Don't forget, with the US, the jobs furlough scheme, the benefit scheme for people out of work, will come to an end in September. So as long as people are spending, as long as jobs are picking up, then expect the expectations for interest rates to rise in the US dollar to carry on. Remember, the big driver in the US dollar, you see these two bullish candles, or three of them actually. These bullish candles came after the June FOMC meeting when the Federal Reserve met, and there was a dot plot shift. In essence, the Fed was saying we expect sooner interest rate rises. That's why the US dollar has risen higher. So keep a careful eye on the data coming out of the US. So I'm neutral the US dollar. I'm waiting to see what data comes. Positive data, good jobs, good retail sales, good employment data. Expect US dollar upside. Vice versa, if those kind of readings are negative, expect dollar weakness. Now, let me go through one chart that has a really good focus. Now, this is the gold chart. Now, first of all, let me just show you something. Right, this is the gold chart, and I just got the gold chart here. I'm going to put it to you. I'm just going to make it the candlestick chart because most folks will probably find the candlestick chart easier to look at. Okay, so there's a line. Let's just see. Can I change that into? Let me just see if I can change that setting into a candlestick chart. It's not that. Okay, I'm going to leave it as it is. This is the gold chart in the blue line. Okay. Now, the one key chart you need to keep an eye on is what's called real yields. Now, real yields is the nominal 10-year bond yield minus inflation expectations. Now, I've got the Treasury inflation protected instrument on the chart, and that tip, or tips as it's called, is basically a proxy for real yields. So just consider this to be like real yields, okay, for the sake of argument. So when real yields fall, you see gold rises, okay? When real yields rise, gold falls, okay? So the basic relationship is rising real yields, falling gold. Falling real yields, rising gold. So this is a chart that people look at very carefully. So falling real yields equals rising gold. Now recently real yields have been falling, and if you look at the 10-year yields, you've been able to see 10-year yields, look, you know, bond yields are falling very low, okay? Now that fall in real yields has been resulted in some gold upside. Now gold is just at the moment at a key inflection level. Now, if real yields keep falling, you'd expect gold to rise. Now, you would have expected gold to rise higher with these real, you see these real yields taking out these recent lows? You typically expect gold to move up higher, back up towards its recent highs. It hasn't. Why? You've got to factor in the dollar as well, the purple line. So you can see the strength in the dollar has been meaning that gold hasn't been able to rise as quickly as it normally would. So this is what to look for gold. The perfect scenario for gold is falling dollar and falling real yields that will really result in gold upside. So you can see here, let's have a look where we get, yeah, so here's a good example. So here you can see the dollar falling, real yields falling, gold rising sharply higher. So when you get falling real yields, falling dollar index, rising gold. Here we've got falling real yields, but dollar's been rising. So what we're waiting for is the dollar to fall. Now, if the real yields pick up towards the dollar, then expect gold to fall. So gold, and if we take a look at it just here, this is the gold chart, candlestick chart, is just tucked under this key overhead resistance. So this is the chart that you need, okay? You'd have treasury and protected securities, tips or real yields, and when the real yields fall and if dollar keeps falling, expect gold to go upside. But if real yields rise, so if we see a recovery in those US 10-year yields, also see maybe inflation expectations dropping, then we'd expect upside in real yields and upside in the dollar, and we'd expect downside in gold. So that's what you need to look for golds for sure. Okay, so keep your eyes carefully peeled for gold's moves, and it's the real yield chart that you need, but don't forget to factor in inflation expectations and the dollar. So that's just explaining that. Okay, folks. Okay, Kingsley in the question says, just bought the prize by Daniel Jurgen. Looks very good for info oil. Can anyone, any books on oil? Okay, so if anyone's got any books they recommend for oil, please do let Kingsley know. Yeah, the prize by Daniel Jurgen. Yeah, okay, that's good. I haven't come across the prize. I will take that. I will have a look at that, Kingsley. So thank you for that tip. That looks worth checking out. Suman, can we expect double tapering from Bank of Canada? So basically the expectation, Suman, is 1 billion Canadian dollars taper per week. That's really what we're expecting. So that should, the expectations are for CAD to strengthen. Now you've got to remember, it's difficult to trade that into the Bank of Canada because CAD is weak today and it's weak on oil. Remember that if you put US dollar CAD over the oil chart, you'll see that they are almost perfectly negatively correlated. So let's just have a look. So you can see here, look, when US dollar CAD falls, oil's rising. Okay, so let me just, this is inverted. Let's invert the scale. So you see when oil is rising, then CAD is strengthening. So that's US dollar CAD downside. Okay, when oil is falling, That's US dollar CAD upside. So remember, if you're trading CAD, always have an eye on oil. So whenever you're trading CAD for the Bank of Canada decision, always be aware what's happening with oil. If oil is rising, that's strength for the CAD. If oil is falling, that's weakness for the Canadian dollar. So bear that in mind. Sarah, yes, this is being recorded. Thank you. Oh, okay. Kingsley says it's not just oil. That book. Yeah, Sarah, usually the recordings get put up on the HYCM website. So just go along to HYCM website, and you should, if you go to the HYCM website, let's just see. There is a section on the website, and it's under education, Sarah. And if you just go to the webinars and workshops, you have the previous webinars on the YouTube channel. If, Sarah, you go to the YouTube channel and the latest webinar is not there, please just contact support and they'll be very happy to send you a link to the latest webinar. Yeah, a good book, Kingsley, that I would recommend is The Technical Analysis of the Financial Markets by John J. Murphy. It's a very good book, particularly for technical analysis, and would complement fundamental analysis very, very nicely. Okay, folks. Yeah, good, Sarah. I'm glad you enjoyed the webinar. Don't forget, we have another workshop here on Wednesday. That's specifically for HYCM clients. And I'll just show you the workshop we do. On the workshop, I go through how to pick a currency pair or an instrument to trade, and we look at the factors involved in doing that, how to choose a strong currency against a weak currency, and also it's opportunity, Sarah, if you've got any trades that you're looking at, or say you just want to run past me something like I'm looking at trading gold or oil, what are the factors that you're looking at the moment, or if you just ask a question like, what's the best opportunity that you see this week? I'm always happy just to point folks in the direction of the things that I'm looking at and explain the reasonings for it, Sarah, and that way you can sort of develop and grow your own skills over time. That's the way these webinars work, and some folks have been following me for years now, and they're sort of well on that pathway of understanding market fundamentals and putting that together with the technicals. So very, very nice to have you here, Sarah. Yeah, that's good, Kingsley. Okay, folks, thank you all very much. It's been a pleasure. Don't forget, back again on Wednesday for all HYCM clients, and on Monday we're back again for the look ahead workshop. And next week we'll be looking at the ECB rate statement, which is looming and should be very interesting for the euro. Don't forget this week, New Zealand dollar, Canadian dollar, and keep an eye on the dollar. Thanks very much. Take care now. Have a great week. Goodbye.